Hello, and welcome to the February 4th Virtual Investor Conference, the second OTC Markets OTCQX Banks event. My name is Rachel Nussbaum with the OTC Markets Group. Before I introduce the next presentation, a few quick points. Please ask questions in the questions box below the slides. Questions will be answered as time allows at the end of the formal presentation. After the presentation and question and answer session, don't log out. You will automatically be transported to the First Resource Bank's booth where you can continue the conversation via the chat box and access additional investor materials. On a final note, all of today's presentations are recorded and are available for 24/7 replay at your convenience. At this point, I am very pleased to welcome Glenn Marshall, President and CEO of First Resource Bank. Welcome, Glenn.
Thank you, Rachel. Welcome to First Resource Bank's Investor Conference on February 4th, 2016. As Rachel said, my name is Glenn Marshall, and I'm the CEO of First Resource Bank. I'm joined here and being helped by Lauren Rinaldi, our CFO. She's going to run the presentation and the questions for me. So let's take a quick minute and look at our forward-looking statement. Thank you. So First Resource Bank is located in Chester County, which is in southeastern Pennsylvania. We're a suburb of Philadelphia. We have 2 physical branches, and we closed out the year at $200 million. We have an entrepreneurial customer base, which acts as a great referral source to the bank for new business. Those individuals are running operating companies, purchasing real estate to add to their rental properties, or they're builders and they're building houses for resale. We consider ourselves to be a hybrid community bank, which has high-touch branches and high technology, and we'll show you some of the examples of that later in the presentation. A little bit about the people at First Resource Bank. Lauren Rinaldi and I, the executive management team, started the bank 11 years ago, and we're also joined by Lisa Donnan, our Chief Lending Officer, and Natalie Carosa, our Chief Operating Officer, to round out the 4-member senior management team. That team has in excess of 100 years of combined community bank experience. Over the last few years, we've continued to add quality team members so that we have the team to take the bank to the next level. This is the 3rd time that I've started out in a small community bank and continued to grow it, have another growth story. Lauren and I are joined by 7 local business people, and I've always had an independent chairman of the board. And this group is an excellent referral source. So the bank has an excellent team to move it forward. Like we talk about in real estate, it's all about location, location. Chester County is a great location. It's a great market for the bank. It has 500,000 people, is the 7th largest county in Pennsylvania. You can see down in the corner is a map of Pennsylvania and where we're located. It also has the largest median income in Pennsylvania at 85,000 people. To drop a couple of names, we have 2 large employers, Vanguard, the money market manager, and QVC, the shopping network, as employers in our county. But we also have a host of small businesses and medium-sized businesses that give us a great employment base in the county. Our unemployment rate is 3.6%, and even at the worst of the Great Recession, those numbers were in the low 6s, high 5s. So really good market. We've seen some accolades to Chester County from some major publications in the country. Forbes and Money have ranked it in the top 10 in places to raise a family and places to live. And I think this is indicative of most of the surveys of Chester County. So we have a great team and we have a great market. A little bit about the banking aspects of that great market. When we look at banking, we want to deal with the core deposits. Our first branch is in Exton, it's the center part of the county. Has $155 million in deposits, and is the 16th largest branch out of 181. There's 38 branches in the county in excess of $100 million, and we use that $100 million as one of our paradigms for a hybrid community bank. We think each location that we put up has to have the ability to get to $100 million, and that's a tough road to hoe. There's only 15 branches in the community bank sector that have gotten to $100 million. But we think that's important. If you're $200 million, you have 2 branches. If you're $600 million, you have 6. We think the old model of being $600 million and having 12 branches just doesn't work from a delivery standpoint, cost standpoint, and you're ignoring the technology that's out there to help you save on your overhead. So you have to have that efficient banking strategy, and I think I forgot to tell you that Chester County is an $11 billion deposit market. Now we're in two of the nicest parts of that market. Exton has $1.9 billion, and we have an 8.2% market share. And then Westchester is a $2.8 billion. So we think that both of those areas demonstrate the ability for us to get to $100 million. We're linking those two locations with proven technologies that avoid the need for us to have numerous branches. It gets back to the old model versus the new hybrid model. We don't think you can be a wholesale bank with one branch with a lot of wholesale deposits, nor can you be a bank with a lot of small $30, $40, $50 million branches. We think this hybrid model is where community banking is going forward. But you need the branches, you need a deposit base, you need that organic walk in the branch deposits to fund your loan growth. You can't fund all your strong loan growth with wholesale deposits. So that both of those locations are billboards. I mean, they're on major highways. We've gotten accounts just recently. We got a couple of accounts from somebody who walked in and said, "Love the building." So one's on the major north-south thoroughfare through Chester County near the Pennsylvania Turnpike. The other is on the road that accesses the county seat in Westchester. So not only are they retail locations that are branded, they both look this way, they're also billboards in high-profile locations. The interior is friendly, comfortable. Each of the locations has a nice waiting room, fireplace. The flow of for our staff and for the customers is great. Staff can get up and greet people as they come in the door. Lines of sight are excellent. We have commercial lenders in the branch. We want decision makers on the floor in the locations so customers get the sense, and because it's true that they're dealing with someone that can help them and make a decision for them with their questions. So a little bit of a summary on community banking, on a hybrid community banking, excuse me. We want to combine high-touch branches, great friendly staff, and high technology that's offered by the national players. We absolutely believe that you don't need to be on every street corner, but you also need to be available 7/24. So you need to have a flexible delivery system, software platform so customers can schedule their banking when they want to do it, whether it be at midnight when they're making a deposit on their mobile phone or going into the branch in traditional banking hours. A little bit about that technology. We're pretty technology focused to the point that right now 46% of our deposits on a daily basis are coming in electronically, whether it be through our remote deposit capture or our mobile deposits. Now the remote deposit capture is our Fred system, and obviously the mobile is your cell phone. All of these products are delivered free to the customers. We don't see this, like a lot of banks, as being a fee-generating business. We see it as a cost savings. This mobile technology, this remote deposit, costs us 10% of what it would cost us for a physical location, and it's available 24 hours a day. We see a lot of traction on the mobile banking side with our small business customers, contractors that can actually make a deposit from their office, which is their truck. And where we really think of mobile banking as being an individual-based product, we're actually seeing small business applications there with good success. So we look at our key operating strategies. First, foremost, end of the day, on the asset generation side, we're a lender. We've morphed the lending mix over the years as we've gone out of the Great Recession. We did a lot of consumer early and a lot of construction. We've really morphed it over the last 10 years to being a commercial lender, whether that be an operating business, a builder, or someone that's building a 1-to-4 rental portfolio. We're getting a little bit stronger yields because we're customizing the loans to the individuals. We're looking at their property, we're looking at what they need, and we're matching what their needs are. We absolutely want to be in that trusted advisor role with our lenders. We're working hard on the deposit side to get in a similar role, but we're taking that consulting approach, developing those lending relationships. And a lot of our lending relationships we've had for 11, 10, 9 years, and some of them have come over with our lenders from prior institutions. And that group looks out for the bank and actually refers a lot of really good business to the bank. So the customer base is actually generating a lot of business on the loan side for the bank. So let's look at our first chart and slow down a little bit. There's a lot going on in this chart, but the history here is loan growth and a loan-to-asset ratio that's higher than our peers. We had 12% loan growth year over year. We had 12% the prior year. And if you take this chart back going to day one, we've always had really strong loan growth. We historically aren't big on the investment portfolio side. We look at investments as an opportunity to make a future loan. So when you look at the green line, our loans to asset ratio has always been in the 85. I mean, I can tell you we've been 90, but we're really in the 85% range. When you look at our peers, which are 100 to $300 million banks in Pennsylvania, they've typically been in the 65% range. And I don't think that's atypical of what you see in a lot of community banks around the country, that lower loan to asset ratio. We just don't think that's a model that can work. Less branches, higher loan to asset ratio, and you'll see the benefits of that in our net interest margin. So let's look at the net interest margin. And this is about the gap. I mean, even though you see the peer there in the red, and that's that same 100 to $300 million banks in Pennsylvania, we continue to maintain a gap between ourselves and our peer, and actually we've widened that gap. We think it's about smart growth. You don't want to have to give the loans away and adversely affect your net interest margin. You want to continue to grow the loan portfolio profitably and maintain your net interest margin. Now, our net interest margin turned down a little bit towards the end of 2015, but if you've followed our press releases, that's related to our $4 million in sub-debt. It had a 14% erosion in the net interest margin related to that transaction. But the economics of that are great because we got rid of preferred stock dividends. So smart growth is the takeaway on that slide. When you look at our operating strategies, because we have good overhead controls and we have limited locations, we do have the ability to be very competitive in deposit situations that we want to win. But we really have continued to focus over the last couple of years in growing our organic core deposits. Now, when I say organic, we're not manufacturing a product to get core deposits. We're not running some crazy rate thing with some checking account just to make it look like core. We want core. We want to get dollars in Chester County and lend them in Chester County. We're always going to fund our loan portfolio. If we got to do some wholesale, we are, but we really want to focus in the next couple of years to improve our ratios on what we call low to no, which is individual interest checking and business checking that has no interest. We think that we can enhance our profitability. We've added a chief retail officer in that area who's done a lot of good work in the last 4 months, doing a lot of re-education on some of the branch people and helped us hire the staff for the second branch. So we're really encouraged with our deposit growth, but also the mix in that growth as we move forward. There's been a fair amount of disruption in our market. I don't know that everybody follows it like we do, but there's been a lot of mergers in the Delaware Valley, which is around Philadelphia and Chester County. We have only hit the tip of the iceberg in how that's affected customers. Even though there's been 4 or 5 announced, there's only been a couple that have actually had their integration period, and probably only one where the honeymoon, where they now are starting to integrate the fees that they want to charge to customers, has actually started to happen. That's a huge home run for us on the deposit side. We think that the disruption in 16 and 17 will be enormous, and we have to be in a position where we can take advantage of that. We've added a few business development people who are calling just on the deposit side, and that was a big success for us in 2015. So on the balance sheet growth side, there's a couple things that are additional factors in here that I want to take a second to look at. We recognized in 2012 that we needed a second location. We needed to be able to keep up with our loan growth with organic deposits. So we bought a location. It didn't open obviously until 2015, and you can see that deposit growth from 13 to 14 was pretty flat. In 14 to 15, it's up 16%. So we bought it, we executed it, we planned well there. I mean, we're planners. And we've continued to have good loan growth, 12% year over year the last 2 years. So we're seeing the benefit of the branch. We're continuing to see the loan growth. There's probably a side story here. You hear the investment bankers right now talking about you have to be $1 billion. We actually don't think that's the case. We think you have to find those profitable sweet spots that fit with your overhead. 350, 550, 750. We've positioned ourselves to get to that next sweet spot. We've added some overhead this year. We've added a second location. We think we can be profitable at each of those different locations. We think we can handle what everybody talks about from a regulatory cost standpoint within each of those sweet spots. And we've planned to kind of jump into each of those next levels, and you'll see that in our charts that you go forward when you listen to us next year. So key operating strategies. We talk about technology, but we're not going to develop the technology. We are going to take it off the shelf. We have a great technology partner in our core processor. 7 years ago, they recognized the benefits of remote deposit and reverse engineered it, and we jumped all over it, and it was a home run. A mobile banking, same thing, and we love being able to say we have a branch in everybody's hand when they have their cell phone. When they say, "Where's the branch?" I say, "Right in your hand." Person-to-person payments is coming out. We think that's the next. We think that's the next big thing. It'll get some traction. We think over the coming years, it'll definitely get some traction with the younger folks. We want to have our product mix hit every different layer of customers that are out there in the market, young through old. I'm not going to say that the old want to go to the branch because they're pretty technologically savvy too, but we want to be able to access everything whenever you want to access it. We're going to continue to outsource everything we possibly can. We think that gets us the best, smartest people in the industry without adding an enormous amount to our fixed overhead. So we think all that translates into fundamentally having to have really good overhead control. Now this chart is our overhead to our average earning assets and also our peer group. We want to look at the gap here. And we historically have had a gap between ourselves, a very positive gap between ourselves and our peers. It's the same $100 to $300 million banks in Pennsylvania. I cannot tell you what happened in the second quarter of 2015. It was up a little bit, then it was down. But if you draw a line between the end of where the chart was and that point in the third quarter of 2015, you'll see that gap continues. We think that's an anomaly. Our overhead has gone up. It had to go up because we added the branch and we added the people to get to the next level. But you can see it's just starting to tip over as we're growing the bank, and we're starting to see that tipping point with the average, and we'll pull that back down to where we've historically been. So we're set up to grow to the next level, which for our case is probably $300 million in the next 3 years. And I'm going to flip to the next chart. Sorry, kind of caught myself there. Net income growth. Banks aren't hockey sticks. They're not going to grow like a hockey stick. Nice, steady growth, smart growth, absorbing overhead, being in a position. I mean, we've continued to grow our income as we've continued to grow our earning assets. Net income was up 7% from last year, 5% from 13 to 14. We like that growth. We've managed to absorb that growth with everything else that was going on. And I'll show you in the next slide, we actually projected 15 to be a little harder, and we planned well and executed on our plan. A couple of years ago, we talked, when we looked at this slide, the difference between the blue and the red. The blue is the net income to common shareholders. The difference there is our small business lending fund preferred stock dividend. Now that dividend was flexible. It was 5% when we started, and we got it down to 1% through our lending activity. We also have gotten that dividend down in 2015 by repaying 75% of it, thus eliminating the dividend. Now, as you may or may not know, a lot of those dividends have gone to 9%. Ours would go to 9% in April of 2016. But if you saw our press release this morning, we just got approved from the FDIC to pay that last 25% back. We expect that to occur in March. And that'll totally eliminate the risk of being at 9% on that dividend and really close the gap entirely between the red and blue lines. And we're Really happy about that because that was a plan we put in place about 3 or 4 years ago, and we've just been grinding on the execution of it. We recognized 3 years ago when we were doing our strategic planning that we needed a better source of fee income. We looked at our natural fits. You know, there's things that are available to banks or insurance and title, but we thought our natural fit was something related to lending. Obviously, SBA lending jumped out at us. We put a plan in place and put a budget together for 14, which we exceeded. We achieved our 15 budget. We just recently made an offer to a person who's going to be a primary lender for SBA that has years and years and years of experience, a great addition for us. We think this will be a core piece of our future profitability. We don't expect it to take over the bank. We still like that margin business within our loan portfolio, but we also recognize that we need fee income to continue to grow the profitability of the bank and give us that other source of income in addition to our normal margin business. So let's go back a little bit on the capital structure. We opened the bank with $10 million in capital. We've done 5% stock dividends over the last 10 years. We did 2 special cash dividends, one in April of 14 and one in May of 15. Now, within 2015, we had a lot of capital things going on. We set up a capital plan after we modeled a ton of different scenarios, and it looked to us like $2 million in common and $4 million in sub-debt was the right mix. Now, remember, that sub-debt is Tier 2 capital for us, so even though it says sub-debt, it's capital. On the common side, we built in a little bit of an overage of $300,000. So when we rolled that out in June, the absorption was great. We sold the whole 2.3. We actually turned away 300,000. I'm probably low on that number, back into the market to generate activity for the stock. We saw good trading as a result of that because we created demand and folks were back in the market buying. Later on in the fall, we closed on the sub debt, so we raised $6.3 million of new capital for the bank. Some of that was for growth, but a big piece of that, the 3.8, was to get rid of the SBLF in November. So that was 75% of our SBLF. We sat down after the capital plan and looked at the follow-up to that, had a strategic planning session with our board. And when we really looked at the future 25% of the SBLF and the cost of the dividend, it really became kind of a self-funding prophecy. So we applied to the FDIC and they granted the approval for us to get rid of that last 25%, which is our press release this morning. So we're very happy on the capital side. There was a lot of moving parts in 2015, but at the end of the day, the economics to the common shareholders are great because we get rid of the risk of the 9% dividend, we raise common, we have sub-debt, we have a much more efficient capital structure going forward. OTCQX Best 50, we were thrilled with this award. We love that platform. It's really helped the execution of our trades with our common shareholders. We've seen much more efficient matches and much better volume on that platform in the last 18 months. So we're coming down to the last slide, which is our book value versus our market value. A couple of different things going on here, but market values in red continue to increase. Obviously, we're thinly traded and still subject to the 100 shares on any given day that wherever it's going to be traded. Book value has continued to increase. Now remember, in 15 we raised common. It was dilutive by 34 cents, and we made 64 cents per share. So we added to the book value at the end of the day, even though we raised common equity on a little bit of a diluted basis. And we had calculated that pretty hard because we didn't want anything that was too dilutive because we wanted to be good stewards of our original shareholders' capital. And then the yellow lines, the overriding is the price per book. We think there's hidden value in the stock. Obviously, we're still trading below 1 times book. We think it's a great time to get into the stock and see the benefits as we continue to close that gap to get it over book. Good time to buy. The last slide is our contact information. If you think of a question sort of after the presentation, this is my direct number and Lauren's direct number and our email, so feel free to contact us with your questions. I'm going to look at Lauren, and she's going to hand me the first question because we're doing these live, so give me a minute to read through it. So the first question is, in the 2015 common and subdebt offering, how much did the board purchase? Good question. Our directors purchased 30% of the common and 5% of the subdebt. We always thought the subdebt would be an outside purchase. Prior to the raise, our ownership around the board table was 24.8%, and after it was 25.7%, which was absolutely our goal to maintain the ownership level in that capital offering. We thought that was very important. Next question is, what is your tangible book value? As of the end of the year, it was $824. Sorry, let me get caught up on the questions here. Banks. What is the bank's efficiency ratio? So for the calendar year 2015, it was 70.9, and for 2014, it was 67.8. Okay. Okay. So next question is, how is the bank positioned to face interest rate hikes in the future? Really good question. Probably don't have all the time to answer that. We've been looking for an increasing interest rate scenario for 4 years. We positioned, obviously, when we do our ALCO, our Asset Liability Committee function, you have to do the typical, up 100, 300, 400 type analysis, but that rarely ever happens. What really happens is a slow increase or a twist where the yield curve flattens, and we positioned the bank for the latter. We're very well positioned for a slow increase and a twist that we've actually seen happen with this most recent increase by the Fed. Future dividend plan. Good shareholder on the line. Our board is committed to being really good stewards for our shareholders. We continue to want to return funds and benefits to our shareholders. We've shown that in, other than the Great Recession, we've done something, whether it be a 5% stock dividend or a cash dividend in the last 10 years. I mean, the combination of both of those two events, we've done something 7 times. So there's always a discussion around the board about doing something for the common shareholders. When is branch 3? Okay, well, if we follow our model and we say that in the next 3 years that we're going to be getting to $300 million, then that would translate into we better have branch 3 ready to go, queued up, and or open. So that's kind of the plan. We're looking at all the sub-markets within Chester County right now. We hope to have something acquired in 17 and open it in the beginning of 18. There's been so much disruption in the market that there's so many locations that might be available that we really want to spend the next 6 months really absorbing, who's closing what and what market, we can really jump into and get to $100 million. How is asset quality? Improving. I mean, we had net charge-off this year of only 9 basis points. We worked really hard in this area. We were down from 32 basis points in 2014 and 43 in 2013. We continue to manage that from a style of we want to work with customers, we want to minimize our losses there, and we really would like to help people get back on their feet, which we used through the recession and even the latter part of after the recession to try to help people get back on their feet, turn things around, and not create a loss for the bank. And I think the numbers kind of prove that. Okay, what are the catalysts in the growth of your book value? Net income's obviously the biggest driver. We think going forward, especially in 16, that the elimination of the preferred stock dividend is really going to help continue to build book value, because everything that we earn is going to go to the common shareholders and will continue to grow book value. The potential for that dividend, had we not done anything and planned for it, would have been $450,000 in 2016. So not taking our net income and giving half of it to the SBLF fund was a huge item that we identified, 3 years ago in our planning, and we've worked really hard to keep all that money to our common shareholders, which will then benefit our book value. I think I got the last question that's out there, and I think that's going to be it. I'd like to thank everybody for their time and their viewing, and those of you that might listen to this later on, and First Resource Bank, FRSB. Thank you.